The Australian Financial Review.
Hello, I'm James Thompson, Senior Chanticleer columnist at the AFR. Welcome to our weekly news breakdown of all things business, finance and markets. With me today, as always, is my Chanticleer colleague, the man who's already getting his receipts and tax deductions ready. It's Anthony McDonald. How are you, Anthony?
Party time of the year, James. I'm excited.
Fantastic. This week we relive what was a pretty extraordinary day for the Australian share market on Tuesday. We go through the 2025 financial year's winners and losers and take an old chestnut of a question about the Australian housing market. But first, Anthony, it was the Wild West in Australian deals this week. A scrappy fight over corporate bookmaker PointsBet, which is the number 4 player in online betting in Australia, turned into an absolute farce when the company's biggest investors' shares were not counted in a takeover vote. Anthony, we always think the world of deals is so slick. You got the bankers and the lawyers and the high-powered dudes in their suits, and they're almost always dudes. What has happened here and who cocked up?
James, truly, mate, for all the people that want to bang on about how risky and murky private credit is and private equity and all that stuff, mate, look at what's going on in the ASX. This one's a doozy. It's pretty simple. So you got a Japanese social media company called Mixi that wants to buy PointsBet for $400 million in cash. Now that's kind of remarkable in itself. A Japanese social media company wants to buy an Australian bookmaker, but park that aside. So PointsBet shareholders had to vote on that deal on Wednesday.
Yep.
Like you said, its biggest shareholder, which is another wagering company called Better. People might remember that from the big promotions it was running a couple of years ago.
Yes.
It was dead set against this offer and had vowed to vote its 19.9% stake against the deal because it wants to buy PointsBet separately.
Gotcha.
So Better, this pretty noisy startup chaired by Melbourne Storm's co-owner Matt Tripp, who's probably the biggest name in bookmaking, it lodged a no vote in the lead up to the meeting, which you're allowed to do in pre-meeting numbers, and those numbers were published for everyone to see.
Gotcha. Sounds pretty straightforward.
Yet when the final vote was tallied up, Better's shares, worth 20% of the company's, somehow dropped out of the vote.
What?
So PointsBet said the vote had carried. 96% of shareholders had voted in favour of it.
Yeah.
Mixi, the Japanese suitor, put out a statement saying, "Thank you, everyone, for your strong support of
Yes.
the transaction." And Better was like, WTF happened to our shares. Where'd they go? They went missing.
Right. It's hard to know what to say here.
Yeah.
Sorry, how does someone's stake go missing that they've already voted? I mean, can you explain? Is there an explanation?
There needs to be an investigation, James.
Right. Steward's inquiry.
At best, there's just a little cock up here, James, and someone's pressed a button or hasn't pressed a button. At worst, Computershare, which is a $23 billion company and runs meetings like this every day, AGMs, all sorts of share votes. At worst, they have a hole in their system that can somehow let a stake like this drop through it. So everyone's looking at it, James. I expect we'll hear more about it in the coming weeks. This is truly remarkable. But for now, the count has been rectified. Better's stake has been inserted into it and the scheme's been blocked.
Right. And so everybody's equally unhappy, I guess.
Oh, yeah. Total muck around, James. Like, to think that both PointsBet's shares and Better's shares have traded through this, the Japanese bidder, Mixi, must be scratching its head saying, what are we buying into? What is this Australian market? Like, if they can't even get a simple share vote like this, right?
Maybe they've been lucky that they've dodged a bullet here and got out of the way. What a farce. I mean, is there more to come or what happens next?
More to come. I mean, that one's a bit of a storm in a teacup. A shockingly embarrassing one for all involved. But the big thing in markets this week is Iran, Israel, and the US. The week started with the US bombing 3 Iranian nuclear targets, and we thought this could be the start of something big in markets. It was definitely big in geopolitics, James. Yet the tenuous ceasefire is holding, and the market has settled. Or has it?
Well, Anthony, I don't know if you've heard of this new meme on financial markets.
No.
It's 3 words, nothing ever happens. So what it refers to is that people like you and I blather on about world-shaking events, missiles flying over the Middle East, all this stuff, and the share market just goes, whatever.
Yeah.
Just keeps going higher. And you sort of look at the evidence from this week, you even look at the evidence from this year. I mean, okay, markets fell 20% around the time of Liberation Day when Donald Trump announced the tariffs, but we're back at those levels now. Nothing ever happens. So, look, what was this, a storm in a teacup? I'm not sure. I don't think so. I think what we've seen is Iran, and, here I am talking like I know everything about Iran, but at the risk of becoming a geopolitical expert, I did speak to one this week, a guy called Haggai M. Siegel, who's all over this stuff, and he says that there's an interesting sort of dichotomy here. On the one hand, Iran has never been weaker. Israel and the US have hurt Iran militarily, and they're down on their knees from that point of view. But on the other hand, the regime hasn't been changed. They may or may not still have their enriched uranium. In 5 to 10 years, maybe we're back in this exact same position where the regime's consolidated power haven't really given anything up. They've been set back for sure, but how much has actually changed? So, look, I think, though, investors have been able to sort of look past this now. It's pretty clear that Iran's not going to close the Straits of Hormuz, where 25% of the world's oil flows through. That was always the big risk. That was the big fear when the US bombed Iran. It just didn't happen. I mean, the Iranian response was so sort of weak that they rang up Donald Trump beforehand and told him where the bombs were going to be.
Amazing.
So look, I think markets can move on from this. Now, there's plenty of other things to worry about. And Mr. Bear here has always got a million things to worry about. But I think this isn't one of them. This is one where we can move on and start focusing on things like the normal things, like where are interest rates going? What's Trump's next move? July 8th's the deadline for all those tariff talks. There's nothing going to be done by then. So what happens in the first week of July? So there's plenty more else to worry about. But Anthony, I don't know. It feels like this one's past. What do you reckon?
Yeah, maybe you're right. Maybe it comes back in 10 years' time, and by then the ASX 200 will be at 85,000 points and CEO shares will be 190k each. It's amazing, isn't it? Yeah, nothing ever happens. I've been around for 3 minutes, really. You've been around for 10 minutes. I mean, yeah. But of course, we're both scratching our head wondering whether structurally the market's changed, Is there just something about the market now, these big funds getting bigger? We see it here with our super funds, but it's the same story globally.
Yeah.
They have to all be invested somewhere, don't they? And it's amazing that just the support for equities throughout all this volatility is just so strong.
Totally.
We'll get to this. Equities are anchoring returns for investors all over the world. So many people want them to keep going up, and they just seem to look through so much doubt and uncertainty and what could be major events, what might end up being minor events.
Yeah, absolutely. Well, Anthony, let's move to something that was a major event on the Australian market this week. And we finally got there when Virgin, which was bankrupt only 5 years ago, relisted on the ASX with a $2.3 billion market capitalisation on Tuesday, in what ended up being a pretty remarkable debut. Now, somehow the markets calmed following the US's hit on Iran on Monday night, which is right in time for this oil, currency and economic activity exposed airline to fly safely back onto the ASX. Now, 4 days on, Anthony, the stock's still up 11%. That's a very nice debut week. And it's almost like Virgin never left the ASX, isn't it?
You said it, James. Nothing ever happens. But, I mean, in all seriousness, it is noticeably different to the Virgin that was listed here for nearly 20 years ago and went bust in 2020. I mean, that Virgin finished as probably the most constipated company we've ever seen, James. It was hamstrung by 5 big strategic investors on its share register, all of who wanted to be associated with Virgin, but none of who really wanted to take ownership. It was hamstrung by billions and billions of dollars of debt. We had bank debt, leases, listed notes it issued prior to just going under. It was hamstrung by Qantas, which it took on in a price war and both lost. And it was hamstrung by an expensive upmarket strategy and international business that was basically taking on state-owned Middle East and Asian airlines and trying to compete on a cost of capital basis when it never would be able to compete. So this Virgin, James, the one we've got today, I mean, it got rid of a lot of that baggage. It got rid of a bucket load of planes, went back to basics. Really, it lopped off Tiger, lopped off most of the international airline. It got a bit more discipline around capital and the way it managed the business. Most of its problems, ironically, were wiped out by that administration process, James. The debt, the strategic investors, they both got cleared out. I mean, the ability to renegotiate contracts through the administration is also a key part of the ingredients. So what we've had is a bit of a refresh and reset for Virgin. The business is the same, flying people from A to B. The method and customer proposition is essentially the same too, but the setup from a financial perspective is very different. And that's what makes this an interesting business case study.
Yeah.
And what ended up being a pretty easy pitch to sell to investors. I mean, you can see the difference compared to what it was a few years ago. Investors are well aware of Virgin is, what it looks like. They studied it for years when it was listed on the ASX. You can see how this isn't as big and bloated and constipated as the old version.
Yeah.
But, I mean, it's going to take the fullness of time to really assess it. James, Virgin's owner, Bain Capital, it's looking pretty good at the moment. It bought the airline mid-pandemic, battled early as different states opened and closed borders at different times, yet it's now sitting pretty, having made 3.5 times its money and still owns 40% of Virgin. You spoke to Bain's Mike Murphy this week. Was he excited, overjoyed, bloody on top of the world, or just richer and relieved?
Well, Mike Murphy, for those who don't know, is a former Olympic diver, and when you're at the top of the 10-meter platform, Anthony, you don't let too many of your emotions show. He's a pretty calm dude, but look, I think he was absolutely thrilled with how it's gone. Not just gone this week, but gone over the last 5 years. I mean, yeah, there's been some setbacks, but these guys came in with a pretty specific plan to float this thing on the ASX. They were wanting to do that from day one, and that's where they've ended up. And if you think about it, it really has gone pretty swimmingly the whole way through. As you said, they cleared all the crap out of the business in the administration process. I mean, he had this great example, Virgin had a Wi-Fi contract.
Yeah.
Wi-Fi on the plane, someone was providing that. Apparently it was just so over the top in terms of the price that, it would have hamstrung the airline just trying to pay for this thing. Administration just kills that contract. They go and renegotiate a better deal. Boom, done. Mm-hmm. So it's a great example of how you can fix a business in administration. Obviously, there's lots of complication that comes with that. COVID was another spanner in the works, but really this has gone pretty swimmingly. So full credit to Bain Capital, full credit to Murphy, full credit, and he gave lots of credit to Jane Herdlicker, the previous CEO, for driving the business through a lot of the last 5 years. She's handed over to Dave Emerson, the new CEO, who's seems to be very level-headed, very sure of what Virgin is and isn't. He's not going to try and take on Qantas in ways that hurt the profitability. He's not going to do anything out of the ordinary, not going to do anything to upset the duopoly that rules airlines like the duopolies rule so many parts of the Australian economy. But Anthony, one thing that really got me, we talked to lots of private equity firms, the thing that created the big opportunity here was the complexity of this business. The fact that Virgin was sort of on fire and needed a lot of, putting out and then fixing, that's what's allowed the big return to be made by Bain Capital here, isn't it? Is there a lesson in that for us when we think about private equity? Complexity, it's nasty, it's ugly, it's hard to deal with, but it's also very lucrative if you get it right.
Yeah, that's a good point, James. I think absolutely there is something for us to learn from this one. This is where perhaps private equity fits in. If I think about these firms as a whole, Bain Capitals and KKRs, they're some of the biggest names in capital markets and business globally, yet they've been pretty underwhelming here in Australia, particularly in the past 10 or 15 years. And then the blow-ups they've had have outweighed the good news stories by far. They've gone bust on the likes of Healthscope, Accolade Wines, Biz Industries, Camp Australia, which was one of Bain's, Genesis Care, which is the cancer treatment company. This one, though, it's an absolute home run. I mean, as you would say, this is Mike Murphy doing a triple pike with double twist, a high five, and a big bag of cash on the way down. This, Bain's made 3.5 times its money and still owns 40% of it. It's an amazing financial outcome at the moment. And we beat up on private equity firms often, and that's entirely warranted. But this one's actually a good story for private equity. Yeah. And I think, because it came in, it took a risk, it did the hard yards, it hasn't blown up the business or done anything irresponsible so far as we can tell yet. It's restructured this thing, sent it back to public markets where it belongs. having identified IPO as the most likely exit for this on the way in. So investors have been happy to pay the price they listed it at. Maybe customers think they're paying a little bit too much for their airfares. That's probably also part of the turnaround story from a financial perspective. But
True.
But it's probably better than having. Well, it's definitely better, I'd say, for customers than just having Qantas and Jetstar as number 1 and 2. So yeah, I think to your complexity point, this is where private equity fits into the Australian business landscape. This was a complex business, as we've just been through, constipated on all these fronts. PE can get these businesses, do what needs to be done behind closed doors, cut dividends for a while if they have to, inject money where it's needed, and whip them into shape. And then, of course, because this is private equity, along the way, it's gonna take some money out of the business and try and bank some of that cash for their own investors. But I think what'll stick in my mind, though, is this is where private equity can work. And as we're trying to figure out how these public markets, private markets sort of come together and where everything fits in.
Here's the answer. Yeah,
this is a good case of where it can fit in. The other side of this story is just the IPO market. This is a big IPO, high profile. What do you think this means for the IPO market? Is Virgin's debut good enough to get other IPOs flowing through the market in the coming half, do you think?
I think so, yeah. But the caveat is they'll have to meet certain requirements, I think. We're seeing now that you want to float a business that is capable of getting in to the ASX 300 at least, because that's where you pick up the passive flows and that's where the likes of the super funds sort of have to invest in you. So we're seeing businesses that raise around $700 million as Virgin did. That seems to be the sweet spot for inclusion in the ASX 300. If they're private equity owned, then private equity will have to stick around for at least a year, as Bain's doing, and show their commitment to the business. And the thing you always tell me, Anthony, is the only thing that matters is what these IPOs are priced at.
Price.
If it's too expensive, investors will smell a rat and they'll run a mile. If the vendors, particularly private equity, are prepared to sort of do what Bain's done, price it attractively and then get a bit of a pop when the thing lists, then they'll get it away. But it all comes down to price, doesn't it?
Yeah, I think so. this IPO activity can feed off itself, James. We've seen 2013, 2015, 2021 in particular stick in my mind as these big years for IPOs where a lot of them are private equity. And if we on the Chanticleer podcast are not building a statue of Mike Murphy in Martin Place, then perhaps the private equity industry should. James, they've been struggling to sell assets. A big reason why is that the IPO market hasn't been open to them. And they need a thriving IPO market, if nothing else, just to be a stalking horse for them when they go to sell a business. Yeah, so they might not be trying to really IPO it, but they need the threat of the IPO there to get someone else to pay up for it. So I reckon you'll see a stack of these mature private equity-owned businesses, things that were bought pre-COVID, which we're talking 6-7 years ago now. I reckon you'll see them dusted off and primed for IPO in the coming half, James. And maybe the intention won't be to list. Maybe they won't be as prepared and as well thought out as Virgin's. But just the fact the IPO market's open, that can help get the deal activity moving for them.
Yep.
So this will end up being quite an impactful deal on the broader Australian deals landscape.
Maybe we should even take Chanticleer Statues Incorporated public at one stage.
All right, James, let's get to our second topic. And did you know next week is my third favourite day of the year, June 30. It is Monday, which means it's time to get the receipts out and play my favourite computer game, E-Tax. In all seriousness, though, this is the one time of the year when investors, whether they are mum and dad, reinvestors, fund managers, super funds, whoever, they look at their returns for the 12 months and think about what has worked, what didn't work, and how they should be positioned for the coming financial year. This year, James, super funds should have had a pretty good financial year. Equities, and I'm mostly talking about Australia and the US here, they've had another stellar year. The ASX has returned 15.2%, including dividends. Wall Street's S&P 500 is up 13.6% on the same basis. James, that's great news for investors, great for your superannuation balance, I'm sure. But you're pretty shocked it's been so good.
Oh, a little bit. This comes back to our nothing ever happens thing. Plenty's happened this year. We've had Trump's election. We've had scares in the bond market, scares with the carry trade. We've had a full-blown trade war. We've had an actual hot war in the Middle East. And yet the share markets have churned out what are really respectable returns. If you'd asked an investor at the start of the year, hey, would you take 15.2% from the ASX? They would be jumping for joy. And the same with Wall Street. I mean, we've had, I think the context is important here. This is a third really good year for markets.
Yeah, third year.
It just doesn't happen. And Anthony, third year, markets up and profits have gone backwards. Can you please tell me what's happening? I do not get this. I mean, really, we've got to be thanking our lucky stars. It could have been so much worse, but the markets just keep grinding higher. It's got a lot to do with flows and structure and all that stuff. But look, all you care about at the end of the day is when you get that notice from your super fund telling you what the return is, and it'll look pretty good. Can you give us a look, Anthony, at Australian shares? Who are the biggest winners and losers for this financial year?
Yeah, the biggest winners, I mean, we're talking gold miners. James, the price of gold's been through the roof, which is something you also wouldn't expect to be going on when you got share markets at all-time high. So you got, Regis Resources, Genesis Minerals, Evolution Mining, they're all up 125% or more this financial year. Biggest broad cap gainers, Sigma Healthcare, which bought Chemist Warehouse, up 140%. And then some techie things like enterprise software company Technology One, Pro Medicus, both up more than 100%. All these companies have had huge years. The worst, we'll go into some of the dogs at ASX that have emerged. IDP Education, Mineral Resources, Pilbara Minerals, all down, 60 to 75%. So they've had bad years. But James, if you really want to talk about why our market's gained about 15% this year, including dividends, there's one big, unstoppable, almighty force that you can't go past, and that's Commonwealth Bank of Australia.
Yeah.
James, CBA has put on 377 of the index points this year, which is about 40% of them, right? So the index is up 830 points, and CBA's accounted for 377 of them. Now, for context, that's as much as the next six biggest winners put together. It's as much as the 30 worst losers in the ASX 200 have taken off the index.
Yikes.
So when you have such a big stock, James, posting such big gains, it's almost impossible for the index to go backwards.
Yeah.
So I know this conversation is supposed to be broad and about the market as a whole, but really, if you want to think about what the ASX is going to do, you have to think about what CBA is going to do. Broaden it out to the banks if you want, because those four banks are all in the top 10 in terms of contributors for this financial year. The CBA, the most expensive bank in the world, getting more expensive. That's the driver here.
Yeah.
Which is funny because normally we think the driver's, China or Wall Street or earnings per share. To your point.
Yeah.
But this year, it's just not.
Amazing.
James, the super funds will be out talking about their results next week. I mean, it's already started a bit this week. I'm picking up a bit of a equities were great story, outperforming all of this private market stuff that we talk about. It's been like that for a few years now. Does it keep going?
Well, I think you sort of answered this before. I mean, it all depends on Commonwealth Bank in for the Australian index. And in the US, it all depends on NVIDIA. So, I mean, I find it a lot harder to make the case that Commonwealth Bank shares can keep going up because every analyst in the Australian market's predicting Commonwealth Bank earnings won't grow for 5 years. So we're beyond the point of understanding why this stock keeps going up, other than these flows and market structure issues. The one thing I'd say about NVIDIA is, can the AI story keep driving America higher? Possibly, but the market there looks very expensive too. Mm-hmm. So how much more good news can be priced into that market is the big question. I mean, nobody's worried about trade wars anymore. Nobody's worried about the bond market and high yields. Nobody really cares about interest rate cuts. The market just keeps powering on. So is there room for the market to keep running into a fourth year? That would be extraordinarily unusual. But look, maybe what we learnt from the past just doesn't count as much anymore because the structure of the market is so different. So I don't know, watch out. Anthony, what's one developing story that you're going to be watching in the new financial year?
Well, James, just because it is approaching June 30 and heads in this space, but I'm really interested to see how super funds make 10% a year when the equity markets aren't roaring. I mean, 10% a year returns, it's sort of burnt into the national psyche now. Super fund members kind of expected it, even though it's a hurdle that's kind of greater than the hurdles that the super funds set themselves. So how do you chase 10% a year? Like you say, if share markets do not have their fourth year of strong gains, how do you make 10%? Do you go up the risk curve? Not really possible. Equities are the top of the risk curve. I mean, do they try and reset the national psyche and tell people that you can't expect these sorts of regains? I don't think their marketing teams will let them do that, James. Do they go more into private credit where you're getting sort of 5, 6, 7% on top of the base returns, which is getting you up towards 10%? Maybe, but we know it feels like there's a crackdown coming on in private credit. That's another separate little story to watch, I think, there, James. So, do super funds, do they lean harder on the unlisted infrastructure and real estate assets? Gear those harder, for example? Maybe, but it's going to be hard to do that far enough to make up for share markets being flat. So I reckon that's the place to watch in FY26. I mean, super funds have been so blessed with 3 years of stupendous equity market returns. History tells us, like you say, that perhaps they can't keep running like that. What's the developing story you're watching for the new financial year?
Bit connected to yours, Anthony, and it's the US dollar. So the US dollar has been falling since Trump came into office, and every investor in the world, it seems, believes that the US dollar will keep falling. That's a big issue for our super funds. They have a lot of US dollar assets, so lots of US stocks, lots of US infrastructure, lots of US private capital, private equity, venture capital. So they've got to make a decision. If the US dollar is going to keep falling, that's going to be a drag on Australian super returns. And so they're going to have to start judging how much exposure they want to America. And there's two sort of competing forces there. You've got Donald Trump, who's generally making investing in the US less attractive, but you've still got the world's best companies in America. You've still got the AI powerhouses like Nvidia and Microsoft and Meta Platforms and Amazon doing their thing in America. So you can't ignore the market, but you might want to trim your exposure to it. I think that's going to be a really big story. How do investors get that balance right? A lot's going to depend on how our old mate, the Donald, goes. I mean, he's the developing story you just can't look away from, and I don't think we'll be looking away from that in the next financial year, Anthony. But, mate, we mentioned before that one of your favourite games around this time is plugging your numbers into e-tax at the Australian Tax Office and trying to game your tax refund. So with that in mind, earlier today we had a chat with Rob Thompson, Assistant Commissioner at the ATO, about some of the more creative ways people have tried to reduce their tax bill, and he even gave us a couple of tips for lodging your claim. Here's our chat with Rob.
Good morning.
Hi Rob, it's James Thompson here from the Fin Review. How are you?
Good, James. How are you?
Fantastic. Thank you for joining us. Well, we need to address the elephant in the room. We're both Thompsons. Is there a family discount at the tax office?
There's no family discount at the tax office, Jane. Even for myself, we all are required, irrespective if you work for tax office or not, to comply with the Australian tax obligations.
Oh, it's disappointing because you don't meet many Thompsons spelt the right way. So I thought we might be kindred spirits. But it's coming up to your busiest time of the year at the tax office. Was it like the week before Christmas in there at the moment?
Oh, I think it's a bit more like the week before grand final, James. There's a lot of people that spend a lot of time making sure everything goes right at this time of the year. And, it's kind of like the siren's about to blow and we're about to start.
It's the time when people start to think about their tax return, deductions, what they might claim. Inside the ATO, is there a hall of fame of famous attempted claims that people have tried to get through over the years?
Look, there's no hall of fame. I think, though, we do continue to see some slightly crazy claims every year. Some of the favourites of attempted claims over the last year was someone that tried to claim their wedding ring or the engagement ring as a gift donation. And we did have a truckie who tried to claim their swimwear because obviously they used to stop out where it's hot and needed a break and they go for a swim. That clothing is obviously personal in nature and not deductible in your tax return.
I'm enjoying the mental picture of the truckie swimming nonetheless. So, good.
We had a company director who tried to claim a range of things for their working from home expenses, including their deep fryer, a sandwich press, a massage chair, and even their coffee machine, which was worth quite a few $1,000s. Obviously, these are all personal in nature and can't be claimed. They weren't related to the performance of their duties. We had a guy who came to a conference in another city. He also had to get some headshots taken for work. He wanted to look good, so he went and got a haircut and his beard trimmed and tried to claim that on his tax return. And obviously, haircuts, beard trims, personal in nature, can't claim those on your tax return.
Brilliant. How should people sort of approach their return? Is there some sort of basic ground rules that you'd encourage people to think about?
Just to kind of remember our 3 golden rules. One is that you've spent the money yourself and you weren't reimbursed. The second is that the expense directly relates to the income you're earning. And the third is that you have to have a record, which is normally in the form of a receipt to prove it. So when someone lodges their tax return, it will run through a range of programs and a range of analytics programs and data matching. And every individual tax return that's lodged goes through that same process, and that allows us to identify where something just doesn't look quite right.
Thanks for the spirit in which you've approached it, Rob. It's great to make it so human and interesting. And although I'm still disappointed about the family discount,
as is probably my family, James.
we'll be back after the break and have a look forward to what's coming up next week. Well, welcome back. If you want to know more about what we're talking about today and a whole lot more, AFR subscribers can sign up to the Chanticleer newsletter at join.afr.com/Chanticleer. Every Saturday, the newsletter pulls together the best Chanticleer columns from the week and delivers them straight to your inbox. All right, Anthony, Tuesday, start of a new financial year. Sounds like it's Christmas in your place.
Fire up the e-text, James.
All right. It's some really important manufacturing data coming out next week. Now, we don't usually get excited about manufacturing indices, but we're going to get numbers from the US and China, Anthony, which should give us a bit of a sense of where this trade war's at. Like, there are some signs of cracks in both economies, and it'll be interesting to see if that continues.
Yeah, it could test out your nothing ever happens theory as well, James.
Maybe. All right, and then Friday night we get non-farm payrolls, which is the US employment data. Some really interesting things happening in the US job markets. There's signs of weakness. The big immigration cuts are starting to play through, so that will be one of the biggest data points next week, which we'll be watching closely. All right, Anthony, we love questions here at the Chanticleer podcast. This week's our question is from Ash in Queensland. If you've got a question you want to send in, you can email us at chanticleer@afr.com. You can also send us a question in audio form. Just record a voice memo on your phone, include your name and where you're from, and email it to us. And of course, the widget is on all Chanticleer articles at afr.com, where you can ask a question through that method, which is what Ash Edwards from Queensland has done. And Ash asks, the current housing bubble in Australia looks no chance of popping anytime soon. What would you expect could be a potential catalyst that would turn house price growth negative? That's a good question, Anthony.
Sure is. Full-blown war would be one.
Yep.
But no, if we're looking at something that's maybe more in the picture, I'd say it's unemployment, James. I mean, it's not so much a slow, steady increase in unemployment, but a rapid spike. Like if we went from 4.1% where we are now to, I don't know, 7 or 8% at the end of the year, and maybe 10% by this time next year, I think you'd pretty quickly find the house price growth getting into negative territory, as Ash would put it, or as I would just say, house prices plummet.
Yeah.
Yeah. So I think it's all about the unemployment. If unemployment was to spike rapidly, I mean, all of a sudden, you get the wipe a lot of the buyers out of the market. You get people stop spending on renovations on their houses. That sort of frees up supply in terms of the construction of new homes and everything. Not that there'd be that much capital and desire around for it. So I'd watch unemployment.
What could cause a spike though? That's the problem, isn't it?
That is the problem.
I mean, the only thing I can really think of at the moment is AI. Or if we had there's some black swan event, a financial crisis, that it's hard to see that right at the moment, but you could get a combination of those two things. We're seeing a lot of belt tightening already. Maybe there's a spike in unemployment, but Ash, I think it's very hard to see what stops house price growth. I mean, the best we could hope for would be an extended period of house prices plateauing, just staying still while people's incomes hopefully catch up a little bit to where house prices have risen to, and we bring on some more supply that helps to sort of equalise supply and demand a bit better. But I think it's really difficult right at the moment to see the catalyst that would push house prices down. I mean, Anthony, I don't know if you saw this week, but there was a new plan from the Queensland government to help buyers into homes faster, first home buyers particularly. Like all that stuff, you can understand where it's coming from, but it just helps push up prices because supply is limited.
Yeah.
So, Ash, I don't know what it is. Anthony's right. There has to be some sort of event that drives unemployment, and it's hard to see that at the moment. It's not impossible, but it's really hard to see it at the moment. And I think that's the thing that we're all grappling with. If we can't get housing supply up and we can't get it up quickly, then we're going to face a period of house prices staying pretty robust, I reckon.
Well said, James.
All right, Anthony, another big week. You've got a long weekend of collecting your receipts and working out your deductions ahead of you. So we'll let you go, and we'll look forward to speaking to listeners, Anthony, in the new financial year.
Absolutely. See you next week.
If you like the podcast and you want to hear more, consider sharing or giving the podcast a review, as it helps other listeners find us. And don't forget to follow wherever you get your podcasts. At The Financial Review, we investigate the big stories about markets, business and power. For more, go to afr.com and you can subscribe to The Financial Review, the daily habit of successful people, at afr.com/subscribe. Chanticleer was hosted by me, James Thompson, and Anthony McDonald. It was produced by Alex Gow and Mandy Coolin. Our theme is by Alex Gow. Head of Premium Content is Fiona Buffini.
The Australian Financial Review.